I'm going to throw something out there. You love talking about Uber and DoorDash kind of joining up. All right. Instead of paying for Reddit, which by the way, 18.8 billion today. So what, 25 to take it off the table probably, Jason?
Yeah, you got a 30% premium when you take a company. Yeah, maybe even 50% sometimes because it spikes when the rumor comes out and then you have to beat that number after it. Yeah.
So call it 22, I don't know, 3 billion. Sure. Or you could buy Substack. Right? But yeah, no, everyone's going to freak out. Oh my God, don't train against my data. So here's what you do. You buy Substack and then you tell everyone you can keep your current deal with Substack, no training off your data. We're taking a 10% cut. But if you let us train off of your Substack, no cut at all.
Yeah. Or how about if you let us train against it, we'll give you 110% of whatever your subscription revenue is. So you got $1 million in subscription revenue. We'll give you $100K on top of it if you publish on this regular schedule and we like your content. So yeah, that's a great idea.
This Week in Startups is brought to you by Squarespace. Turn your idea into a new website. Go to squarespace.com/twist for a free trial. When you're ready to launch, use offer code TWIST to save 10% off your first purchase of a website or domain. Fidelity Private Shares. If you want the all-in-one equity management platform, Fidelity Private Shares has you covered. Visit fidelityprivateshares.com and mention this podcast for 20% off your first year subscription. And Oracle. Oracle Cloud Infrastructure, or OCI, is a single platform for your infrastructure, database, application development, and AI needs. Save up to 50% on your cloud bill at oracle.com/twist.
Hey, everybody. Welcome back to This Week in Startups. I'm your host, Jason Calacanis. With me, my co-host, Alex Wilhelm.
Hey.
He's x.com/Alex. I'm x.com/Jason. We have a full docket. It's Monday, March 31st. The first quarter is about to end.
Yes, sir.
My Lord, that went quick. And with it, my ski season, 33 days, didn't hit the 41. I guess there's always a chance I might be able to jump on a last-minute ski trip, but it's seeming like it's over. Everything's starting to melt. What do we got in the news today? Man, there's so much going on.
I thought we'd talk about Palantir just for a hot second.
Oh, sure.
We have riffed on this company ad nauseum, especially back when it was at or near all-time highs. And what's changed is that the company is now in a bit of retreat. As you can see here from this chart made by the fine folks over at Sherwood, we were covering the company when it was doing this right here, taking a look at it and going, what's going on? And people told us
this
that we
would be the stock going from $100 to $121. It went parabolic sometime. I guess, when Trump started his Trump's inauguration, it looks like literally January 20th-ish, it went from $60 a share up to $120. It doubled.
It doubled. And essentially, what is that, Jason? Less than a quarter, about a month and a half, looking at that chart?
Yep. And so it's come back down to earth. Now we're trading at about 80.
Yes, sir.
And the 50-day moving average is, there seems to have been this incredible hope that the stock market would rip under Trump.
Mm-hmm.
Then Trump said, remember I said those things about tariffs. Wasn't joking. I'm going to literally create market chaos until April 2nd, which I guess is our new Independence Day.
It's not going to be what everyone hopes, I don't think.
Okay, so Palantir's, I think it's Wednesday, April 2nd. So Palantir's a great company. They have great products. I think they were growing 30 or 40% year over year, if I remember correctly, on a $2 or $3 billion run rate. So this is a legit company. Alex Karp is just GOAT level CEO. They're doing important work in the world. But sometimes a stock becomes a meme stock. And I can tell this because anytime we talk about it, hundreds of accounts will come into my replies. And now they're even paying the $3 donation to charity to reply if I were to mention Palantir has the highest price to sales ratio we've ever seen, right? Yes. I think it was something like 80 at the peak, 70 or 80 price to sales ratio.
Incredibly high.
Yeah. If it's doing 2 or 3 billion in revenue and it's worth $80 billion, you start to figure out what that price to sales ratio is. That would be 40 if we were to do that. Exactly.
Yeah. Just for fun, Jason, I just pulled up the Bessemer Cloud Index for folks on audio, and I sorted it by essentially its current revenue multiple. It's actually enterprise value divided by annualized revenue. But at the absolute peak of all the cloud companies that Bessemer tracks, Palantir is at 59.3x. The next highest is 21.3. So even though it has come down, it's still incredibly expensive.
And the average looks like it's 12, right? So here's what happens in markets. I'm not a market expert, a private market expert, but public markets, generally what happens is if a market retreats, like we're seeing because of the tariffs and just the general non-predictable market we're in, I would say is a gracious way of saying it. Like it's hard to know what is going to happen.
Yeah.
because of that lack of predictability, the market constricted, the chances of a recession went up, everybody's just a little bit on edge. And the Trump bump went to companies that were, in his orbit or military, et cetera. This was already a meme stock like company, or a meme stock, not and a real company. So who's going to take it on the chin first? When a market retreats, the highest valuations get corrected first.
Yep.
And the ones that might be the lowest will lose the least, because if you compress to 3 times, 4 times, 5 times your sales, people are going to be like, there's no compression left. That's actually a buy. So that's all this is just reversion to the meme. If you see, I always do this when I'm at a basketball game because of the threes. If you see a team shooting 50, 60, 70% from 3, you can be sure it's going to come back down to the league average of 35% or whatever it is on a team basis. If a team is shooting 10% from 3, at halftime, it might go back up to 35%. Reversion to the meme, the mean is a known thing. So
I think reversion to the meme should actually become part of our lexicon, because at some point, I presume Palantir will go back up due to market enthusiasm. So perhaps we're going to need both terms, frankly.
Or maybe sometimes people go, okay, that was fun. Let's go on to the next meme stock, or let's make another stock into a meme. Either way, if you owned a bunch of shares of a stock that becomes a meme stock, what your best bet to do, as far as I can see, is to sell it and then to buy the ones that are the great companies that are at the lowest enterprise value by run rate or just price to sales ratio.
Sure.
And so if there were people who were lower on the list that you felt as strongly about the management team and the product and the growth, maybe that's a better buy. So the market giveth, the market taketh away. Let's keep going.
Yes, it does. Well, the biggest news that came out in the last couple of days, Jason, I think definitely was the combination of X and XAI.
Sure.
2 private companies, 1 social media, less talked about category for startups in the last, 10 years. And then, of course, the other hand is the AI company, which is all we've been talking about for a while. I thought it would be good to just touch on the mechanics a little bit. And I think people might be curious about an all-stock deal between 2 companies and how valuations are kind of sorted out. Now, here we do have kind of one person and the same collection of investors taking 2 companies that they've owned and putting them together. But the all-stock transaction, Jason, to me just seemed like a great way to get these 2 companies brought together quickly and without excess faff on the transfer of money side between individual investors. For folks who don't know, Elon Musk, who owns both companies, said over on X that XAI has acquired X, so the AI company is buying the company formerly known as Twitter, and the deal values XAI, the AI company, at $33 billion, so essentially $45 billion minus debt. Jason, your first thoughts?
Yeah, we knew this was going to happen. I predicted it on the show that we would start to see AI companies buy content companies. So if you were Sam Altman looking at this, why not buy Reddit? I'm not sure Reddit's market cap right now. It's probably 15 billion. I know it had peaked and I think it went public at 7 or 8 billion. And I said back then, why hasn't ChatGPT, Gemini, Claude with these sky high valuations just gone on a purchasing spree? They should buy Quora, they should buy Reddit, and then make it unique to that platform.
Yes.
When you are using XAI or using X.com, formerly known as Twitter, and you hit that Grok button and it gives you context, my Lord, it is a great experience. I frequently will come across some term I don't know. Somebody's tweeting about something I don't know any of the context. Click on that button, get the context. Having that real-time data and then blocking that real-time data from competitors is going to be a massive advantage to X.AI.
Yes.
So it's a great, it's a great combination in terms of the mechanics of taking 2 private companies and putting them together. There's a drag along feature. A certain number of shareholders have to vote for something, and then everybody gets dragged along. So I think once you hit, and it could be different for every company because it's in the sort of bylaws of the company that everybody agrees to. When you get 60, 70, 80% of people to agree, then the companies can merge. And the 20% of people who don't sign off or don't agree, well, they signed an agreement that these kind of transactions are subject to the majority wanting to do it. So obviously the majority wanted to do it in both cases. And I think this just locks in XAI as a top, call it 3 or 4 player in the marketplace. instantly, right? They'll be top 3 player in the market instantly. This is the power of M&A, and this speaks to the end of the wrath of Lena Khan. All right, founders, let's talk about your website. Yes, I know it's embarrassing. Yes, I know you're too busy to upgrade it. Well, if you're going to launch something new or you need to give your brand a refresh, which I know you do, you need Squarespace. It's the all-in-one platform that makes building a stunning professional website ridiculously easy. Whether you're selling products, offering services, or showcasing your portfolio, like I'm going to do with one of my kids. They want to go and do artistic things in the world. So I'm going to make them a nice, beautiful Squarespace site when they apply to college. Squarespace gives you everything you need to grow. And you know what? Obviously, you've heard me talk about how beautiful Squarespace's templates are, but now you can get a fully customized website in minutes with their AI tool called Blueprint. Here's how it works. You just answer a few questions, and then you get a beautiful, bespoke website in minutes. Personalized layouts, visuals that are going to stun your customers, and voila, you're done. Want more control? Choose from award-winning templates and use intuitive drag and drop tools so you can make it your own. Easy peasy, lemon squeezy. You get to do it the way you want to do it. So here's your call to action. Just fall in love with Squarespace like I did. Squarespace.com/twist for a free trial. And when you're ready to launch, go to squarespace.com/twist to get 10% off your first website or domain purchase. That's squarespace.com/twist, the longest running partner for This Week in Startups, because they were a startup and they still build their product with the enthusiasm and the cutting edge technology of a startup founder. We love you, Squarespace. I don't think that these kind of private market transactions come up on the radar of the government typically anyway, because there's no public company involved in such a fragmented market. But I do think we're going to just see M&A. And I talked about mid-market M&A countless times in the last year, that would be the big win. Because when you have mid-market companies merge, what do? They challenge the Mag 7. So this is great. This is exactly what I was thinking. You know, Reddit getting bought by ChatGPT, Quora and Reddit merging and then creating a ChatGPT competitor, even better. This is what you want to see in the market. DoorDash and Uber merging, or, you know, Amazon spitting out Zoox and merging it with Uber or Lyft. You know, some combination of those will make for, you know, $250 to $500 billion companies with real revenue. And it's just great for investors as well, because now the investors in each of these companies have a greater chance of success. They wouldn't have voted for it if it wouldn't increase the chances of success. So that's what you have to think. What's going through their minds? And I guess they just didn't want to have the fair market value that Twitter went through go down when it got purchased, right, for $44 billion. Mm-hmm. And then XAI has been on a tear. And the way you value these things is, what are they able to raise money at? And I think they said X.com was raising money at the previous valuation. So probably what happened was you had money being raised at certain valuations. If the market says those valuations make sense, 80 and 45 billion or whatever it is, you put those two together, the market has said, the market participants have pinned them at those numbers, and then it's a go, right? Everybody feels comfortable with it.
I think also an important thing to keep in mind here is how the companies were already operating almost as a conjoined entity. I mean, having Grok on X makes perfect sense if you think about them both from the perspective of Musk, but they were distinct companies. So to see that kind of tight integration, super interesting. Clearly, XAI wants a distribution mechanism and a data source. X supplies both. But XAI was paying part of X's bills because XAI was able to raise more money more recently than X has been.
So that would be for servers, you're saying? They were paying its servers or something?
I think XAI was, the reporting was helping it stay current on its bills. So it could have been as much as helping it service the debt.
So this is another interesting wrinkle in all of this. If the other thing to look at is the downside. If you don't do this, what's the impact on both companies? Well, Meta is going all in on using their customers and their community's data to inform Llama, I would think, right? Like Meta now has an AI search box. So if you're using Instagram or Facebook, they kind of force you to use it even if you don't want to.
Yep.
So then that means for XAI, Claude, or any other independent language model, if you don't have a social network to feed you real-time news, you're at a disadvantage.
I mean, this is, I hate to keep bringing up the same couple of talks from the Liquidity Summit last April, but like, I think it was Antonio Gracias who said like, look, X has a unique data source in the world. That's why his company was backing XAI. And so like, I do think that X by itself had a relatively low ceiling for how much it could become worth, because I think Snap's trading at something like 3 times sales, Jason, going back to your price sales ratios. but AI companies can be valued at bajillions of dollars. So there's a lot of good stuff here. I'm curious to see how much enterprise adoption Grok gets, because when we think about the leading model companies in the US, Grok's models are often up towards the top of, LLM Arena and all those other ranking lists, but I don't hear about as many companies using them in production, Jason.
Yeah, I don't know that they have really pushed their enterprise efforts. I think that's something that maybe ChatGPT has been way ahead of, since Sam worked with the startup community at YC and comes from that sort of space. So
it's a $33 billion deal, essentially, for X, which means that it has surpassed the $32 billion that Wiz sold for, bringing us another pretty enormous deal. Sure, it's all stock. Sure, it's Elon's companies. But I don't know. We wanted more M&A. We wanted to see more dollars in flight. Well, here you go.
Yeah, I retweeted. I saw somebody had a chart about M&A so far this year.
Yes.
Which I guess is from CB Insights or Charter. And we're at $54 billion for Q1. Last Q1, we were at 2 or 3 billion. Q1 before that, 2 or 3 billion. Q1 before that, we must have had something big in 2022. That was 38 billion. So, this chart kind of speaks volumes. We're going to have, at least in the last 4 years, a record first quarter by, looks like 50% almost. So this is trouncing 23 and 24 and greatly exceeding.
Yeah, I think the important thing to keep here is that, sure, it's fun to see the X deal be worth slightly more than the Wiz sale, but the Wiz deal was a pure startup play. It was a venture-backed upstart company from the Israeli tech scene that had a lot of, private capital into it. You love to see it. Whereas X had also some Saudi money, and it was slightly less venture and more private market. So I think the Wiz deal is full. We should just take all of it as a yes in that chart. So I love that data point. Yeah. Enough, Jason, to actually change the tune amongst venture capitalists regarding liquidity, or just a good taste to start the feast?
There were a lot of VCs in X.com, I believe, Sequoia and some other ones, Joe Lonsdale. So they're all going to be now in XAI. I think that's a nice update to send to your LPs. So in a private market transaction, being able to say hey, look, we had a social media investment that's now an AI plus social media investment. Right. That's awesome. What this also does for freedom of speech and, all the challenges that X has had with advertising, this now eliminates that business model because you have the business model of people paying $20 or $30 a month for Grok. So this is one of the, if you double click on this a bit, one of the great things that could come out of the large language model era of consumers paying $20, $30, $40 a month, and executives paying that amount for a large language model, is some amount of that could go towards content creation. And will. So we've already had the, people who are doing reinforcement training, but now why not just buy the New York Times? Why not buy the New York Post? Why not buy Vox? Vox's value has always been I think they probably haven't increased in value in 5 or 6 years, probably.
No.
And then we see Yahoo's selling TechCrunch for spare parts, and it's probably going to be an SEO play. It's kind of like the end of the brand in my mind. If it's going to be part of the PC Mag, Ziff Davis diaspora. All of this means there is actually a viable future for content if you can get a language model to say, hiring 30 journalists to work on TechCrunch and feeding that into the LLM. Okay, that's only $5 million a year for the whole group and their office space or whatever.
Yeah.
Seems de minimis to me. So content as a front for LLMs is a really interesting idea. What if TechCrunch were to break even while feeding? If you bought the Vox, collection of sites, or Penske's collection of sites, all of those collections of sites could actually wind up being worth something to a large language model.
All right, I'm gonna throw something out there. You love talking about Uber and DoorDash kind of joining up. All right. Instead of paying for Reddit, which, by the way, 18.8 billion today, so what, 25 to take it off the table, probably, Jason?
Yeah, you got a 30% premium when you take a company. Yeah, maybe even 50% sometimes, because it spikes when the rumor comes out, and then you have to beat that number after it. Yeah.
So call it 22. I don't know, 3 billion. Sure. Or you could buy Substack, right? But no, everyone's going to freak out. Oh my God, don't train against my data. So here's what you do: you buy Substack, and then you tell everyone, you can keep your current deal with Substack, no training off your data. We're taking a 10% cut. But if you let us train off of your Substack, no cut at all.
Yeah. Or how about if you let us train against it, we'll give you 110% of whatever your subscription revenue is. So you got $1 million in subscription revenue. We'll give you $100K on top of it. if you publish on this regular schedule and we like your content. So yeah, that's a great idea. So this is one of the great things about M&A becoming vibrant. And this is where regulation kills innovation. You start thinking about like, gosh, I wonder what DoorDash is trading at price to sales. It's probably like low single digits, 4, 5, 6%, right? And then what is a self-driving company like Waymo trading for? What is Uber trading for? These things are probably trading for, Airbnb 3, 4, 5 times their revenue. If they're trading for 3 or 4 times their revenue, man, somebody with a Waymo valuation could come in and be like, hey, Waymo plus DoorDash and Uber equals the winner $1 trillion company. Whereas the 3 of them together might be worth 250 million.
Yep.
You put those 3 companies together, I think their value doubles or triples immediately because the market would give them a premium for winning the market.
Okay, so this is really interesting, actually. I know this is not a public market show, so we'll keep it short, but DoorDash's current price sales ratio is 7.3, whereas Airbnb's is 7. So they're very, very close, actually, in terms of how the market has ended up netting them out in terms of a revenue multiple. Uber, by the way, a little bit lower, 3.6, but that's still...
half. It's a lot lower, yeah.
Yeah. I'm just trying to think about if I agree with that.
That's the self-driving hand-wringing. If the self-driving question got answered definitively, it would spring back up to 7. So I think that's all you're seeing there is people are like, okay, are cybercabs and Waymos going to... how quickly could those possibly be rolled out and what impact would it have?
Yeah, well, what's amazing is at Uber's 3.5x price sales trailing, by the way, the company is still worth $150 billion. So if there is a 2x hiding in there, Jason, it's not just $1 billion, it's $150 billion, which is an enormous sum.
Yeah, that's what it should be, actually. I think that's, listen, I'm speaking my own book here. I have exposure to DoorDash as well, by the way. So it's not like I'm and I have exposure to Waymo because I'm a Google shareholder. So I have exposure to all of them. I do think this is the era of M&A that's going to be really interesting is just let people under 250 billion merge with each other, create better products and services. America wins, salute.
I'm here for it.
This advertisement is paid by Fidelity Private Shares.
All right, founders, we all know cap tables, due diligence, and of course, managing investors is a huge headache, but there's a very simple solution for you. Today, we're talking with Kristen Kraft, an old friend of mine, and she works at Fidelity Private Shares, a new group over at Fidelity. You've heard of Fidelity before, and they have a mission to help startups simplify equity management. They're going to save you money. They're going to give you better service. Welcome to the program, Kristen.
Thank you so much, Jason. It's great to see you again.
Yeah, great to see you as well. Maybe just from a product perspective, what are you trying to accomplish with the product?
So, Jason, we are super excited about our cap table management and data room platform. We want to make it super simple for founders and startup operators to manage all sort of ownership and equity in the company and essentially prepare to raise. We want to make sure that everybody goes into these fundraising conversations well prepared, they're ready to share their cap table, and that they're ready to go through due diligence as they're trying to close their round. So from a product perspective, that is where we're laser focused, and that product is really well built, really strong attention to detail in the way that Fidelity is known and beloved for.
So if you want an all-in-one equity management platform, Fidelity Private Shares, they've got you covered. Visit fidelityprivateshares.com. That's one word, no spaces, no dashes, fidelityprivateshares.com. And hey, mention This Week in Startups. They'll give you 20% off your first year subscription. Once again, fidelityprivateshares.com, and tell them that you heard about it here on This Week in Startups.
Circle, the company behind the USDC stablecoin. We've had Jeremy Allaire on the show a bunch. We have heard that this company's going to go public back in 2021 and 22 via SPAC. No. Filed privately to go public last year. We waited. Nothing happened. Well, Fortune reports, Jason, that Circle is now going to work with JP Morgan Chase and Citi on its long-expected IPO. Thank God. Timing not entirely clear right now, but Circle, and I'm going to quote here, quote, aims to publicly file paperwork for the offering in late April. So that means we're less than a month away from finally getting our admits on Circle's public S1 filing. Two things to keep in mind here, Jason. One, crypto is enjoying a deregulatory spring, you might say. People are being forgiven, charges are being dropped, cases are being left behind. That's good. The other thing is we've been talking about the stablecoin boom here on Twist every month for as long as I can recall. And so I think right now the market is hot for exactly this type of company, looking towards the future of finance. So even though the market's choppy right now, I think it's a great time to list. I think this is the right time.
It's a perfect timing for them. They are a trusted, audited, US based. I don't have any exposure to the name. So just to be clear, like I'm not talking my book or anything here. And Jeremy Allaire's, a serial entrepreneur who's well known. There is something called the Genius Act, which you'll be hearing a lot more about. The question is, who will be able to create stablecoins in the US? This is going to become the big question. When this stablecoin act gets initiated, if it happens, we're going to need to look at, should Tether be allowed to service American companies or go public here? I don't think Tether should be even allowed to buy treasuries. Now, I know that's a controversial statement, but if they have a sordid past where they've been banned in many regions and people have all these claims of, the attestation as opposed to an audit, if you are going to have billions of dollars of treasuries and you're going to allow people to magically move money around, I'm going to go with, let's make sure that this operation is extremely tight. Tight is right. And so financial markets should not allow, this is my personal belief, outside actors to operate at scale in markets that should require audits. So this is going to become, I'm just giving you like a little heads up of what we'll be hearing people talk about in the coming months. It's going to be whatever World Liberties, stablecoin, Circle stablecoin, all the domesticated ones, all the ones that are audited and above board, maybe even Stripe will, instead of just having that tool for them, will have their own. Is Robinhood and Coinbase, both of them are going to have stable coins or not? I'm not sure.
Coinbase is very close with Circle and USDC. It's kind of their house stablecoin, if you will. Okay. So I don't think they're.
Okay. So, I did a tweet about this the other day, and the Tether truthers who, believe there's some shenanigans going on with this company. And then the Tether long people, which I don't know how you're a long Tether if it all just equals $1.
Yep.
These companies are going to need to be regulated and taxed or have audits. They don't have audits at Tether. I think they have attestations, or if they call them audits, I'm not sure we would consider them audits to the, definition of American companies. And this stuff all needs to be onshored, and the companies need to be registered here. You should not have people introducing financial devices in this market. Back to tariffs. There should be a massive tariff on anybody who wants to bring a financial product into the US that's not, a US-based company. And that's not a US-based company as best as I can tell. So get ready for a big showdown.
So the Genius Act is the Guiding and Establishing National Innovation for US Stablecoins of 2025 Act.
Okay.
So there you go. I've not read this, Jason, but I will now that you brought it up to me. Is this coming up in your conversations that you're having on the group chats? I just
hear people buzzing about stablecoins a whole bunch. So I won't, I won't get into it too much, but people see stablecoins as a massive opportunity because when you buy a stablecoin, if you buy $10,000 in stablecoins and you just hold them, I'm making the interest on your stablecoin. So I'm making the 5% on your stablecoin. So you're giving me $500 a year for being your custodian. Okay, seems fair. But if you have $1 billion in stablecoins and you're like some, giant company like Coinbase, let's say let's say Coinbase kept $1 billion stablecoins. So should Coinbase be giving $50 million a year to somebody for that, or should they create their own?
Yeah, I think they actually should create their own. I mean, the number of stablecoins out there of scale is not that high. I have a chart here, Jason. I'll just throw up on the video for everybody who's watching. This is a chart from the Block. They have a great data service showing kind of the current scale of stablecoins. There's two main players. There's Tether, and then there's USDC. But if you look at the top of the chart,
Tether is blue, USDT, and they have how much?
About $145 billion.
Wow. So $145 billion, 5% of that.
It's an insanely good business, but it is dependent on interest rates. So essentially, you could think about the value of Circle's business being its net interest margin, which is predicated on essentially tight monetary policy. The looser the Fed gets, probably the less profitable Circle becomes.
If it goes down to 2% of $100 billion is $2 billion a year. And this is where Tether, there were all these claims against Tether because Tether wasn't showing where the money was, and that they might have had Chinese paper, as in private loans to Chinese real estate companies. That was always the big rumor. Maybe they cleaned it up. Maybe it never happened. Nobody knows because you don't have Ernst & Young or KPMG or some notable firm here in the US signing off on it. but they were probably getting paid 15% on that Chinese paper. They at some point wouldn't say if they had Chinese paper, then they said they didn't. So what I
think they
read
probably got rid of it.
Cleaned it up, maybe cleaned it up. But if they were making 15% on 100 billion, 15 billion, and they have been making claims like a public company quarterly, and they're on Twitter, but they're all in different weird jurisdictions. That's the other thing that, CoffeeZilla and other folks who have investigating it. There's a Tether person on Twitter. I forgot his name. I had him on the program. No, Paolo is he the CTO or something?
He's one of the bosses, yeah.
Yeah, he's one of the top 5 or something. No, there is a anti-Tether person who has been investigating them for a long time. And this kid's been deep into it. He's part of that Tether truther.
I've seen him in my ads. Yeah.
Yeah. So he's, they basically have been really studying where are these people based? And they went into their previous companies, and a lot of people in crypto, colorful backgrounds. Previous companies, color backgrounds, different interesting things they did previously. Hey, founders, I want to tell you about an expense that's eating into your profits. Here's a hint. It's not salaries. It's not travel and entertainment. No, it's your cloud computing bill. You probably got some sort of deal when you started off with your cloud vendor, but now your spend has increased. Maybe it's sky high. Maybe you haven't looked at it for a year or 2 or more. Well, what if you could cut your cloud bill in half? That's right, cut it in half and improve your performance at the same time. Well, if you act by May 31st, Oracle Cloud Infrastructure can help you do just that. OCI is the next generation cloud designed for every workload. You can run any application, any AI project, and you can do it faster and secure for less. In fact, Oracle has a special promotion where you can cut your bill in half when you switch to OCI. And these are real savings, folks. On average, OCI costs 50% less for compute, 70% less for storage, and 80% less for networking. Join Modal, Skydance Animation, and today's innovative AI companies who all have upgraded to OCI and saved a ton of money. And this offer is only for new US customers with a minimum commitment. See if you qualify for half off at oracle.com/twist. That's right, oracle.com/TWIST.
I have actually a slightly more generous take now on crypto people. And it's because I've been playing a little bit more poker lately than I had been before. And I just realized that the crypto crowd is just the poker community with a keyboard.
I mean, there's something to that.
Yeah.
Well, there's a lot of that. There's a lot of people in it who are actually anarchists. There are people in it who are libertarians. There are people in it who believe the state shouldn't be involved in currency. They don't believe there should be speed limits, all this kind of stuff. So, and then there's the big cleanup. So I think what's happening in crypto is the big cleanup, and Circle going public will be part of the big cleanup, where it's we're going to replace the players who are below board or who aren't doing the proper dotting the T's and crossing the T's and dotting the I's. We're just going to replace those folks over time in this administration with people who are above board. And so that's the opportunity, is to be an above board player. And it's going to increase people buying treasuries, which is one of the things this administration has a concern about. So stablecoins, I think Tether is one of the largest buyers of treasuries right now. If that was a house of cards, let's say there's a 1% chance that tethered truthers, are correct, or a 0.1% chance. It's pull a card out of a deck and let's see if this thing crashes or has problems. What would happen to one of the large buyers of treasuries?
Well, it dries up, but also they dump. And so there's a flooding of the market, and that breaks the supply demand balance and then lowers prices. Jason, just to kind of back up what you said, in its 2024 kind of report, if you will, Tether said that it had $13 billion in profits. I mean,
that's unbelievable.
That is a staggering amount of money. I hope, by the way, that all the concerns here are overblown. I agree with you on the need to be regulated, but holy crap, that's a profitable business.
You want to kill Tether? You want to just totally annihilate the company in 10 seconds?
Hit me.
Very simple. Circle says, if you own USDC, you get 80% of the interest that we get passed through. So basically every year, for every X number of circles you have, we'll issue you another one because of the interest.
Yeah.
And we'll take 20% of that. So if we're making 5%, we'll take a point. You take 4. That's the end of Tether. Boom. And you know what? If you're second to Tether in the market right now, why wouldn't you do something aggressive like that? You know, it's kind of like Robinhood. If you move your money into Robinhood, they give you this incredible bonus. You have to keep it there for a couple of years. Like maybe you have to keep it for 3, 4, or 5 years, but they'll give you like some 2%, 3% bonus for moving your money from, I don't know, Goldman, Morgan, Fidelity, wherever, to them.
Wow.
That's kind of interesting and aggressive. So, and those kind of things have always existed, but it doesn't exist in stablecoins. It's kind of nuts that people use these stablecoins and don't get the interest on their money. So somebody out there should launch a stablecoin that distributes the money to the people who own it minus a VIG, a reasonable VIG.
Crypto rewards, and I know there's some nuance here with Coinbase that I'm sure that I've forgotten the details of, but no one's being that aggressive. I do think though that as Circle tries to go public, it's probably not going to be working on new ways to give away 80% of its revenue. But if I was someone who wanted to take down Circle and Tether, my bad, then I think that would be a great way to go about it. I will say it's going to be one hell of an IPO. Let's go. Isn't it good to be excited again about debuts, Jason?
It's great. The thing I would encourage everyone to look at is also anti-money laundering and terrorism, human trafficking. Those 3 should be looked at deeply with any offshore stablecoins. If they don't have those, and I think, you know, the thing about this Genius Act, really great name. I love the way they name these things. I would say we should have incredibly high requirements around anti-terrorism, money laundering, human trafficking. If you get caught with your stablecoin not doing KYC, not having really tight controls, I think it should be banned. So I think Tether, if the DOJ and some of the investigations are in fact correct, I think they would be banned day one, not allowed day one. And I think that would be the right decision for this administration to make. I'll make a prediction. I think this administration is going to have to make a difficult decision here because Howard Lutnick is involved with Tether.
Yep.
World Liberty Financial is onshore. Circle is onshore. We've got a lot of people here who are in and around this administration and family who have exposure to stablecoins. And then you have this Genius Act. Who's putting the Genius Act up?
Mr. Haggerty and Mr. Scott of South Carolina on the Senate, and then also Gillibrand and Lummis. So 4 senators, 2 from each side of the aisle.
So let's see what their donations are, how they're conflicted, where this is all coming from. So I think, we'll maybe put that on the docket for Wednesdays to double click on all this.
All right. Elsewhere in IPO land, just very briefly for everyone out there who cares about equities, Jason Cerebus Systems, the maker of massive chips for AI inference associated with G42 and that AI push in the Middle East, has tinkered with its IPO. Now the G42 company is going to purchase stock in it that will not have votes, and therefore it's not going to run afoul of the Committee on Foreign Investment in the U.S. And reporting says that the IPO is going to go ahead. Love to hear that. CoreWeave went public last Friday. We talked about it live on the show.
Yeah, how did it do?
Well, it was about flat on its first day, and right as we were starting this show, it was down about 8.8%, and it's now down 9.5%. So the stock market is selling off today, but a pretty crappy day for CoreWeave to endure. So that's not so good.
It means that they top ticked their sale. Remember, when they sell their shares, you want to get the highest price possible. Having a bump on your IPO might feel good emotionally, but if it's terrible for shareholders. If the stock were to double on the first day, it means you sold a bunch of shares at half off. Here, they sold their shares at a 10% premium. So good for them. They got 10% more than the shares are fair market valued. So the shareholders now have to make up that 10%, but they get to deploy that capital and do interesting things with it. And then they got a free 10 cents on the dollar.
Yeah, they're going to pay off some of their debt. They're going to keep investing and growing. I don't think it's the end of the world when a company's IPO doesn't go quite as planned, but we do hear a lot about people leaving money on the table. Well, here's the opposite. They stole the table when they went public. Good for them. Finally, eToro, don't forget, has filed to go public. StubHub has filed to go public. And if you care about niche media in the United States, Newsmax went out with a Reg A+ listing, which is very interesting. I just got to look into this a little bit, Jason. Clearly going public on the back of an election cycle, which is good for politically tinged news. But always fun to see more companies getting out. We love seeing more total public companies. So that is the rundown there.
Reg A is basically, you can offer up to 75 million. It's incredibly expensive if you don't hit tens of millions of dollars, because you have to start filing and do a little bit more reporting. So generally, it works for people who have a good relationship with their customer base, and their customer base wants to invest in it. Reg A it's one of these things that if we could allow an accreditation test, you wouldn't need Reg A. And so it's kind of like, gosh, how do I say it? It's kind of like split the baby between public offerings and private offerings, and it just doesn't work as smoothly as it should.
I mean, I feel like that's also true about SPACs. And so my immediate vibe when I saw this was, ugh, because it just seems like kicking open the back door to go around to the front of the building. Like it feels like an unnecessary complication on a thing that already works for companies that are mature and ready to go public.
I've always felt like SPACs, and I said this at the time because a lot of my friends were doing them, and I always felt like those were dipping down into being an aggressive VC, betting on crazy things. And if you're a VC and you're betting on crazy things, you're expecting 60, 70% to go to zero or not return capital.
Yeah.
And you're expecting your returns to be in the 1 in 10. So if you were to look at SPACs through the lens of a venture capitalist, if 1 in 10 performs greater than 10x over, some period of time, it was worth doing. If they don't, and you're buying only 1 or 2 SPACs as a retail investor, that's the problem. Like Joby is this flying car company. And some of my friends were investors in it, like Sky Dayton, et cetera. Mm-hmm. Always had an affinity for that company. One of our companies, Desktop Metal, went public, 3D printing. It was Desktop Metal was worth over $1 billion in private markets. It's worth 150 or 250 million.
164.
It's like it's worth 85% less. Joby would be worth 10, 20, maybe worth 20 billion as a private company. I don't know what it's worth as a
4.7.
So it's also 75% off. The public markets don't know how to do deep tech, crazy Hail Mary, binary outcomes. And I think that's the lesson of SPACs is retail investors are looking at quarterly reports. They're not taking a 5-year view of these things of what if it works. I also think a couple of actually, maybe more than one of the quantum computing startups went public. So you start going public with flying cars, space tourism, 3D printing, and quantum computing. This is like high risk investing, folks. Those are the things that SPAC. And I think the people who took them out, I think the CEOs of those companies are probably sitting there going, maybe should have been private. Maybe should have stayed private.
Quantum SI, I believe, went out with a SPAC, and it's currently worth 220, Jason, and it's worth $1.20 a share, down from an all-time high of over 20. So another similar kind of story of just
95% off.
Yeah, it could
or
work.
95% off the peak. And that's the other problem is people go, oh, quantum computing, I'll give it a premium. This is the naivete of a retail investor. I'm super realistic. 9 out of 10 companies go to zero. Doesn't change my pulse. I go to those founders. Didn't work out. What do you got next? Because I know that every 100 companies or so, I'm going to hit a Robinhood or a Calm or a Grin or some company that's going to pay off 50, 100, 200 to 1. And then, what if I hit an Uber and it does 5,000 to 1? What if I hit a Robinhood and it does 3, 4, 500 to 1? You can really make up for a lot of zeros. The retail investors started to think, well, of course it's going to be worth 100 times this because it's deep tech. What they didn't realize is 1 out of 100 of them might become worth 1,000x or 500x.
Yeah.
Sure, that's possible. Maybe it's even probable. But you only made 1 bet.
Yeah.
Or you made 3 bets. You don't have enough surface area to hit one.
Accredited investors, sophisticated folks, let them play. Keep the people who don't know what they're doing out. You and I are on the same page here. Just a little bit frustrating to see history constantly repeating itself. Jason, I want to move on to a segment that I'm very excited about because we have a guest dropping in today. So today, for office hours, we are going to meet with Caylee Harrington from Hookhub. They are building the Airbnb for RV parking.
Yes.
You can find them at hookhub.co, on Instagram at HookHubRV, or over on X at Hookhub_RV. Please welcome to the program. It's Caylee. Caylee, how you doing?
Doing great. Yeah, it's good to see you again.
So you went through the launch accelerator. Which cohort?
33, the most recent.
The most recent one. And before that, did you happen to do Founder University or did you come directly?
Nope, I did the university right before that.
Awesome. And we invested in you, obviously, for the accelerator. I'm not sure if we did the Founder University 25K bet, did we?
Not at the university, but the accelerator, yes.
Did you ask us for that bet? Did you request it and we said no? Or did we offer it and you said no? I'm just curious.
No, I actually didn't know it was an option for the university.
So this is, Alex, the thing we're doing is sometimes we meet people who are pre-incorporation or they're just figuring it out. And so you are Airbnb for, explain the pitch.
Absolutely. Yeah. So I'm the founder of Hookhub. We are Airbnb for parking your RV. So we're a marketplace where you rent out unused land space for RV parking.
Got it. So if I happen to have some land in the hill country in Austin and I had a couple of spare acres, people could come and park their RV there and I could charge them for doing so. Is this for people who want to live in the RV there or store the RV or both?
Both. Yeah, that's what we're all about, is every form of RV parking.
Got it. And what are people's current choices to park their RVs?
So for short term, there are a couple apps, just vacation, and there's RV parks. But for long term, there is no apps right now. So pretty much people are going on Google, calling RV parks. That's the option.
And this doesn't exist on something like Airbnb. They don't offer Airbnb parking on Airbnb?
No.
Got it. So you have to build up supply and you have to build up demand. There are RV parks. There must be marketplaces or directories of RV parks, no?
There is. Yeah, there's apps out there where you can just, find locations of RV parks.
Got it. So what you provide is another option. I can see here it's $60 a night to park an RV. Is that about right? Is that the average price in America? What's the average price in America to park your RV?
Yeah, so actually depends on area. It can range from 20 or $40 a night up to 150. We do have lower rates when they stay longer, but yeah, just nightly tends to be higher.
Does it need to have electrical hookups? Does it need to have internet? Does it need to have water hookups? How does all that work?
So that's optional. The host can list with no hookups and get bookings. Of course, if you offer those, you can charge quite a bit more.
So let me just back into the math here. If you were living the RV lifestyle and you needed a place to park in America for a month, you would be, what's the average monthly?
About $750 would be average. Yeah.
That's pretty dope if you think about it, Alex, from the perspective of like somebody who doesn't have a home, they live in their mobile home. For $10,000 a year, they can basically park all around the country. What do national parks charge for your RV parking? I'm curious.
Oh, I haven't looked lately. Some of the rates are getting really high. If you're just doing nightly, there's like 100 plus.
Really?
Wow.
Yeah.
So several times as much.
Yeah.
Yes.
So you could be spending $3,000 a month if you're parking in premium places.
Oh, yeah.
So it's not necessarily if people are thinking about van life, which is another wrinkle to all of this. There's a new category, van life, that I want to get into because I'm always following trends. I'm like a trend guy, and van life is different than RV life. RV life, a lot of boomers, they're retired. They decide, hey, I'm going to go out for 3 months a year. And instead of staying in hotels, I like to have my stuff. And I think a lot of it is socialization. You get to meet people, other retirees, and you can go to cool places. And it's kind of like, I don't know, it's kind of like a Harley Davidson, kind of like Americana, being on the road thing. I kind of dig that. But tell me, is van life playing any role here yet? Because that seems to be young people who are white collar workers, digital workers, knowledge workers who want to have their cake and eat it too. They want to have the beautiful retirement, but they might be on like a FIRE, financial independence, retire early kind of hybrid. So that's another trend Alex and I have been tracking. So how does van life play into any of this, if at all?
Oh, it definitely does. Shockingly, it's almost half of the RVers now are the younger generation. They're the 35 to 54-year-old remote workers.
Okay.
So yeah, it's every year it's getting larger for the younger generation.
And tell me about that cohort. Does that mean like the entire space has doubled, or you're just getting a greater percentage of them? And how many people in the United States, let's say, are living this lifestyle, I don't know, half of the time or more?
So it's 1.2 million Americans are living full-time. There is more when you consider the snowbirds, doing the 6-month thing. So the 1.2 million is just the 100% of the timers. And so each year we are seeing growth still just overall in the RV market, more people switching to that life for all ages. But we are seeing the percentages based on age groups is shifting more and more to the younger.
So it's the opposite of the Harley Davidson problem. When their average customer gets a half year older every year, you're going the other direction.
Right.
Jason, just to underscore the thing you're talking about, in 2024, there were 310,000 RV wholesale shipments, up 6.5% from 23. So even in a post-COVID world, we're still seeing this track up over time. So it seems pretty bullish as an overall just market to sell into, Caylee.
Yes.
So how's the business going? How is fundraising gone? And any challenges you're having? You're, an early stage startup here. Maybe how's it going? How's the traction? Where are you strong? Where do you need help?
Yeah, traction's good. So that's good. We're keep going up and to the right, about 20 to 30% growth each month. So things are looking good. Yeah, things are looking good.
20% month over month growth is what we consider high growth. Yeah, that means you're doubling every 3 months, right? Yeah, rule of 72. Yeah.
Yeah, so that's been good. It's still, we have a lot of challenges as a small startup. So fundraising has been difficult due to the fact that we're not in a sexy market, everybody's looking at AI. We're in the RV industry. Most people in the VC world don't really understand that industry.
Got it. Okay. So you have to educate them like we just did. Now we're cool hunters here, Alex and I, so we understand van life and financial independence, and we're tracking this kind of stuff. So you have to educate VCs on the opportunity, but there are VCs who love a good marketplace. Yeah.
Right.
And have you been able to identify that subset and talk to them about, hey, here's the vision and why this is worth the time? Amongst the people who understand marketplaces, what's their objection? Is their objection they're unsure of the growth rate? They think it's a small TAM? Well, tell me. Let's double click into that group of that subcategory of VCs, the ones who get marketplaces like me.
Yeah, no, you're exactly right. So we've talked to a couple marketplaces, investors, and they're excited by the idea, but it does come down to that. They don't understand the market still. They're unsure the growth potential. They've told us that blatantly. So I keep sending updates showing them, the market.
Well, I think this is where maybe sharing the growth of the market and having a vibrant build in public or social media. So have you gotten to the point of having a really tight social media designed around van life, designed around featuring your customers, featuring your hosts yet? Because that would, for a lot of investors, prove there's something there. Tapping into the Reddit, the subreddits, tapping into the Instagram tag, van life. If I were to pull up your Instagram right now, would you be ashamed or would you be proud?
Both. I would be proud of the content, but I just started. Very recent. So, and I'm also getting a consultant I'm getting a call with later today, and they're going to help with our 2-year strategy.
Okay. And I see you've got 600 followers there and you're just starting. I'm going to give you a piece of advice. I believe that if you, the founder of the company, can master TikTok, YouTube Shorts, and Instagram Reels, which is all the same thing. If you can master it, I think that you're going to solve maybe 3 or 4 problems all at once. Number one, you're going to solve investors because they're going to go to your social media and they're going to start there. And they're going to see, oh my God, there's a there there. There are people interacting here. Number 2, you're going to solve supply because people, if you start featuring your supply on your social media, will want to be featured. Number 3, you're going to solve demand because people who are looking for supply are going to find it there, right?
Right.
And number 4, you could solve for employees and team members who are, the best team members for this startup are going to be people who love living in a van. So if you found a marketing person who's a social media marketer who would join your team, who lives in a van, you could probably hire them for $1,000 a week. Probably the expectation of a social media manager who knows how to edit short videos, who works remote, might be 50 or 60 or 70K. That's probably their expectation. And then if you told them, here's your job, I want you to go to each of our customers and take pictures of them and to go interview them and to make shorts out of them and then interview people who are also living the van lifestyle. their brains would explode. Now you've got somebody who's living van life, who gets to have a job geeking out about van life. And that person's waiting for you at the van life tag on Instagram or TikTok. And they're already making these videos. And when you come to them, they're going to think, Caylee's an idiot. She's going to pay me for what I'm already doing. How do I know this? Because when I was running Weblogs Inc., we hired a guy named Ryan who was an incredible commenter. And he would comment underneath Peter Rojas's, Ryan Block would comment under Peter Rojas's posts and annoy him by fact-checking him. And he would write longer comments than Peter Rojas had written in the blog post. So we said, hey, you're writing 12 comments a day. How about we pay you $10 to write, 5 posts a day? And he was like, are you an idiot? And I met another kid who was doing Apple blogs at the time. Blogging was not a paid pursuit. We did the same thing with him, and we created a blog called TWA, the unofficial Apple weblog, TUAW, and we got TWA.com. It was like a phenomenon for 3 or 4 years. It was a very popular blog. And again, somebody was writing about it on their Tumblr, and we hired them. And they were like, Jake Howell's an idiot. And at that time, we offered $250 a month to do 100 posts.
Oh, wow.
So it was 3 posts a day. This was our first deal because people were doing it for free. And in fairness, people were writing 3-sentence blog posts. Here's a cool video of somebody, doing something with their MacBook Pro. I think that if you had my money and you said, hey, Jake Al, could I spend it on this? I'd be like, I wonder if that would be the best use of proceeds, solving all those problems at once.
Yeah, that's a great point. I've thought, to be honest, it's crossed my mind, but I've never just went all in on that. And I think it's time I just do that.
Here's an experiment for you. Offer 3 different people you find, one on TikTok, one on Instagram, one on YouTube, $1,000 to do 10 videos over the next month, and whichever one you like best, hire.
I love that. I'm going to do that. I'm going to keep you updated on how it goes.
Well, I mean, then but you have to learn these techniques well. So you have to, be watching van life and say, who does the best van life videos?
I just found this over on Instagram. This is the current rundown of how popular the van life and van life associated tags are. Van life diaries, 2.8 million, hashtag van life, 17.8 million posts. I had no idea, Caylee, that this was such a big deal. I thought this was just Jason and I dweebing out about not having to pay property tax anymore.
Yeah. Actually, and so that observation, Alex, very well done. Yeah. The observation that you don't have to pay property tax, you should make, I kid you not, a post a week on that one topic. One of the things I learned about shorts is that you're not going after subscribers, you're going after the algorithm. So doing tax hacks or property tax, now you can hijack property tax and tax optimization people. There's a whole expatriate thing and leaving America or leaving your country to go to the people who treat you best on a tax basis. That's a whole other genre. And so there was a concept called news hacking, which sometimes became distasteful. People would be like, here's my SaaS product talking about, I don't know, Russia's 9/11, Russia's invasion of Ukraine. Like, you can do news hacking in a very dark, bad way. But there was news hacking of, I am a security expert and Andrew Weiner's phone got hacked. Boom. The day that hack happens, we're sending a short article with 5 bullet points to 100 journalists. Alex and I would get those. What we're doing here is trend hacking. We're doing tag hacking. And the tag hacking and trend hacking, subreddit hacking is a very powerful pursuit. I wish you great luck with that. Any other problems or challenges I can help you with today?
Well, that was wonderful. But we are wondering too, should I focus more on adding features for the user base, or should I focus more on adding team members focused on growth, kind of like you brought up?
You're currently growing 20% month over month, which means you have product market fit. And you apparently know how to find customers, right?
Yes.
So you could go crazy and try to grow 40 or 50% a month. The only problem with that is you might not have the customer support. You might get a low NPS score, et cetera. And you're having a challenge with raising money. Not a challenge. It's this is actually what you're experiencing is the normal process. How many investor pitches have you done? Not just pitching to the people we introduce you to in the accelerator. We introduce you to hundreds of investors. You get to pitch them. I'm talking about direct one-on-one Zoom calls for 20, 30 minutes with an investor. How many of those have you done ballpark? Dozens?
4 or 5.
Oh, 4 or 5. Okay,
Yeah.
great. So I want you to add a 0 to that and report back. So
Okay.
that would be the much better thing, is to take this segment, share it with people. Hey, I was just on, This Week in Startups with Alex and Jason. Here's the clip. Here's the deep link. We talked about a lot of the issues. I was wondering, you're a marketplace investor, if I could talk to you about my business and get some great advice from you. We're growing 20% a month. So I don't want you to give your life story to them. I was on This Week, and we're a startup. We're a marketplace. I know you're a marketplace investor in these 3 other marketplaces. We're growing 20% a month. We're dealing with a lot of challenges because of that growth. Here's a link to me on with JCal and Alex. Would love to get 20 minutes to get some advice from you about marketplaces. So you're not asking for investment. You're just asking for advice, and you're sharing 2 bullet points, 2 main points. And you're going to try to say it in as short, as least words as possible. Number 1, we're growing 20% a month. We're growing 20% a month. 5 words. I was just on Twist with JCal and Alex. 8 words. So you have 2 sentences. One's 5 words, one's 8 words, and there's a link in each. And then would love to get 20 minutes of your advice since you're an investor in A, B, and C. That's another 10 words. So we've kept the email to under 50 words. We've done it in 3 bullet points. Then I want you to ping the person if they don't respond every 72 hours. Moving this up to the top of your list, moving this up to the top of your list, moving this up to the top of the list.
Okay.
On the 4th one, I want to say, don't mean to be annoying. I just really respect your track record in marketplaces. And that'll be the last one you do, the 4th one. Ping 1, ping 2, ping 3. And then the 4th one, I want you to say, sorry to be a bother. I really could use your counsel since you have done so much great work in marketplaces. Is there anybody else at your firm I could do a first call with? And then we'll let it go for now. Okay. Every 3 days, you're going to be annoying. How uncomfortable do you feel about those 4 follow-up emails?
I don't. I didn't realize to follow up that often. I wait like a week and a half. I had no idea.
No. I want you to create a sense of urgency. So I want you to create 20 targets. I want you to send 20 emails, and I want you to follow up on them with a personalized follow-up. Jason, moving to the top of your inbox, enjoyed you on this other 20-minute VC podcast. So you're kind of showing it's personalized. It's not like a thing. Any chance I could get 15 minutes of your time from 6 a.m. to midnight, any day of the week, Saturday and Sunday included, right? You're kind of, what you want to do is show that you're going to be relentless. And you know what? Relentless founders is what we like to invest in. So there's some VCs who are like, yeah, I'll respond if they ping me 2 or 3 times, or they go through somebody who knows me. So that would be the thing. But I think you got a great growth rate. I think mastering the social media piece with people, because how many people full-time in the company now? 2, 3?
2 full-time.
Perfect. The 3rd person, if they were somebody living van life, would serve as a proof point. You could have them get on the phone with investors. They would serve as a ambassador. They would serve as an SDR, sales development rep. They could warm up leads. They could be customer success because they visit somebody. Man, if you were like, the more I think about this idea of tapping a van life couple or an individual, and it has to be somebody who's an extrovert. So, somebody like Presh who worked for me, who, I don't know if he's an extrovert actually, but he plays an extrovert on social media. He's out there building his products in person. He's going for runs, videotaping himself, sharing his friends. You need somebody high energy like that. They might skew younger, but they don't necessarily. So they just have to skew that they're already doing the job. Paying somebody to do a job they're not doing already is hard. You're kind of pulling teeth. When I hired Alex, he was already doing podcasts and writing and geeking out about S1s. I didn't have to be like, Alex, read this S1, read this 10Q. He's like, I'm sorry, I can't talk right now. I'm reading a 10Q.
That's why I'm so fun at dinner parties.
Or maybe he doesn't get invited to that. I don't know. It could be either.
No, I want to jump in here though, Jason. This employee, this number 3, this van life SDR, ambassador, content creator. How much equity should a startup give to an early key hire who's a non-founder? I think this comes up a lot. And while we're here, let's take a moment.
You can give them a point if they stick around for 4 years. 1 point.
Okay. That'd
be generous. It'd be generous, right? You could be generous with the 3rd employee. Now, if they were the CTO and they were joining and they had done 2 other marketplace startups, they'd probably ask for 5%, 10%.
Oh, wow.
If they were getting like less than market salary. So let's say the CTO who worked at another marketplace, not Airbnb, obviously, but maybe they did work at Airbnb and were one of the first 50 employees. They made a little bit of money. They may not want a 150K, 250K salary as a CTO. They may want to take a 100K salary or a 5K a month draw, 60K a year. They might want to invest 250K, to own 5% of the company at a $5 million valuation and get 5% equity, over 5 years and get to like a 10% ownership position. So that's what you're kind of dialing in here. This person probably doesn't care about the equity. I'll be totally honest. If it's a van life person, and they're optimizing for fire, they would look at the equity as icing on the cake. So you could probably get away with 25, 50, 75 basis points or a point. If they're savvy, they might want 2 points. Mm-hmm. And they could, if they were like chief marketing officer, CMO level, Alex, to your point,
yeah,
a chief marketing officer might ask for 2 points, 3 points, 4 points. Mm. And then here's the great news. They're on a 1-year cliff, Caylee. Mm-hmm. If they suck, or if you suck, conversely, and they don't want to waste any more time because they don't think that you're going to make this happen and the equity's aggressive, they quit, you quit them. Or if you can't quit each other, that means something good's happened and they get that nice 20, 25% of their equity, on 12 months and 1 day. So we've built that protection into startups. It's called the cliff. And the cliff exists for a reason.
I think this is fantastic. If you want to learn more, like I said, it's hookhub.co, launch accelerator class 33. Caylee, thank you.
Thank you, guys.
It'll be interesting to see if in time, van life becomes so big, thanks to things like Starlink and Project Kuiper and so forth, that people do kind of do the mass Airbnb strategy, but for RV spaces. I can see that becoming a small business. Anyways, I think the company is great. I'm curious about their splits, though. I didn't get a chance to ask that, but I wonder if they have like Airbnb level revenue splits with hosts.
We'll see over time.
All right. So this is a clip from Andrew Reed. He was on, I believe it's the Tech Bros podcast.
Oh yeah, Tech Bros. They're the ones who do the ESPN thing where they put the logos of the sponsors along the bottom.
Yep. So here is Andrew Reed from Sequoia on the podcast talking about how the Sequoia partnership works and how founders interact with it and how they get sometimes surprised. Here we go.
Well, I hear often Sequoia, I've heard is really tough internally, really sharp elbowed. The stakes are really high. It's a small team. Expectations on performance are insane.
It's a consensus investment process as well, where you don't need to just basically close you got to close, if you're an entrepreneur, you got to close all your partners, correct?
Exactly. And the partner meeting, I've seen some founders really rise to the occasion in the Sequoia partner meeting room. I've seen people just totally wilt. It's actually an amazing culture inside the building because of that. I think because the expectations are so high, the team is so small, right? I think this is one of the things that, Doug has this presentation, he calls it the laws of physics, where one of the laws of physics is that fund returns are inversely proportional to team size. And also fund returns inversely proportional to fund size. We've been very disciplined about keeping the number of people on the team and keeping the funds to a relatively stable size and then working together to kick ass.
All right. Yeah, great clip. That rings true. Having pitched the Sequoia partnership, having them invest in one of my companies, that I ran as CEO, and spending time with them and them being an LP in my funds and me being an LP in their funds, I've got a great, deep relationship with them. It is true. The two important points there that Doug Leone, the GOAT, points out, if you have too many people, fund returns go down. If your fund size is too high, fund returns go down. Sequoia is a large organization, but they have a seed fund and, Series A. They have a growth fund. They keep the teams small, high expectation culture. And I do remember at one point going into a Sequoia meeting, I was like, hey, where's blank? And they're like, oh yeah, he wasn't invited back to the next fund.
Ooh, which is how you get fired as a venture capitalist.
No, you don't get fired. You were not invited into the next fund. So you nailed it. It's that's it. That's just the nature of the business is you do get a lot of runway, but then you might not be invited back to the next fund if you don't hit the notes that you need to hit.
Yes.
The end.
Now, Jason, on the pitching point of this, founders wilting, founders rising to the occasion, what does a Sequoia partner meeting feel like? It sounds like they're all there at once and you're pitching literally all the partners for the fund that you're looking at.
I would say big ears, small mouth is how I would describe pitching to them. They are not going to say a lot. you might get 1 or 2 questions from 1 or 2 people, and then they will follow up. And I think, they are looking for a certain archetypal founder or founders. Now, a great market size, great early execution, track record, those things can play into, any of this, in terms of decision making. But, they're looking for very specific, Peter Thiel, Elon, Chad Hurley, Max Levchin, go down the line of, intense founders who are super driven. Reid Hoffman, I'm going through the logos in my mind, Steve Jobs, the Cisco founders back in the day. So they're looking for highly driven, cantankerous, chip on their shoulder, hardcore founders. And I think because they have such a high number of people applying, that they probably are okay leaving some good investments to other firms and going for the Larry and Sergey, Drew from Dropbox. They're looking for really hardcore folks. And you know what? Hardcore folks also, myself, Sam Altman, probably didn't get great returns for them, but still hardcore folks who they identify, who they know have a certain amount of pride and doggedness. They don't expect every investment to work out, but they do want, Tony Hsieh in the building, they're Alfred Lin, who's now a partner there, or Ruloff was on PayPal. They're looking for hard driving, chip on the shoulder entrepreneurs. And so having a bit of a chip on your shoulder probably is an asset. Zuckerberg famously showed up to pitch them in pajamas and did a whole pitch of why they shouldn't invest, that kind of stuff.
That takes stones.
Well, I mean, it was also put up to it by Sean Parker, but the whole 4-quadrant thing that Don Valentine said there famously, competent, incompetent, easy to get along with, difficult to get along with, or sometimes difficult or challenging individuals.
Yeah.
Highly competent, challenging individuals are the outliers in our business. So, pick somebody, Travis, Elon, they may not be easy to get along with at times, but they're highly, highly capable. That's what you're looking for. Yeah. That doesn't mean, you have to be difficult in every decision, but sometimes that is a flag. And, we have that sometimes. Sometimes we'll have somebody who comes to the accelerator, like we, have people here come on office hours, you meet them, and they want to make 5 changes to the standard documents. And we're like, we don't, for the accelerator, we don't do that. But for a direct investment, we very well might change some standard documentation because, we generally will advise them like, these are the standard docs. You're going to make it more difficult for you the next time.
Right.
So, we suggest you do that. But if they want to have in there that they can, keep running or be on the board of this other company, or they want to be an advisor to this venture firm, Raul has a venture firm he set up. Not that we were like, he didn't have that when we invested, but if somebody like Raul was like, I also want to do this venture firm with my brother or whatever, my friend, and that's a no-go. If I can't spend 5 hours a week on it, I'd be like, okay, fine.
Right. Josh Wolf from Lux Capital says, chips on shoulders puts chips in pockets, I think is his summary of this.
He cribbed it from Sequoia. Yeah, true.
Yeah, but I can I just say there's a little note of shade in what Andrew is saying there, because if I think about who's raising the largest funds,
he's talking about Andreessen Horowitz. Yeah. I think all of those funds are going for the average venture returns. And so what you'll see,
capital. Yeah.
I mean, the average venture return should be double the public markets. If that does, or even if it's 50% more than the public markets, and you're Mark Andreessen and Ben Horowitz, and you index the entire space, and you're putting $2 billion, $3 billion to work a year, and you've got $20 billion under management, you know what the management fees are on that. It's just a money printing machine. So that is a strategy to be essentially vanguard funds of venture. Sure.
Mm-hmm.
In a way, Y Combinator and what I'm doing at launch, they're doing 500 investments a year in their accelerator. I'm doing 100. We'll probably get to 200 in our next fund. That, in a way, is taking pre-seed or seed and making an index of those. Well, it turns out the pre-seed and seed index, if you actually succeeded in that and you indexed it, you would be the greatest fund of all time, because they typically do 2x what venture does. So you might actually be able to establish a 3x fund, 4x fund, like that would be, or 3.5, that would be pretty juicy. So, there you have it, folks. If you could institutionalize a 20% year over year return, and you can keep making the number go up, pretty great.
Yeah, Warren Buffett will be calling you at that point in time because that would be...
Yeah, but you get no liquidity, right? So that's what you're giving up, right? So if you get the Vanguard fund and an average is 7 or 8%, or like whatever, if it's a tech fund, it does 8 or 9%, like, and you can come in and out of it as you please. That's a feature. In venture, you can't. And in venture, you have to have a group of people who get the allocations from 10 different people, so that you're in 10 different seed funds, and that's what a fund of fund is for, right? So there are fund of funds that try to accomplish that task, but you are going to not see your money for 5, 10, 15 years.
15, yeah. That's
well, you'll start seeing some, maybe if you're lucky at 5, 6, 7, you'll start seeing most of it between 8 and 12, and you might see some stragglers at 13, 14, 15. If you're running Yale's endowment or the Ford Foundation or a sovereign wealth fund, who cares? Like 15 years, 10 years, 20 years, it's all the same. You don't need access to it because it's only 5, 10, 15, 20% of the portfolio. So
speaking of venture capitalists and returns and LPs, Jason, can I show you the funniest comic I've seen recently about venture capital? I pulled it up for us. This is just for fun. If you're on the video version, you see this. If you're not, it's a 2-panel comic. There's a man in a suit talking to a guy in a hoodie, and the guy in the suit's labeled VC, and he says to the founder, "You're just a wrapper on an LLM." And then the founder turns around and says, "Well, you're just a wrapper on an LP." And this is niche humor, Jason, but it had me absolutely rolling. I loved it.
It's true. It's sort of like saying YouTube is a wrapper around S3, storage,
sure.
Seagate. Yeah. Okay. Sure. Netflix is a wrapper around
negative
fiber
cash flow
optics cables or, whatever. Like, sure. All right, everybody. This has been another amazing episode of This Week in Startups. He's x.com/Alex, Cautious Optimism on Substack, and go spend $100. Pay for his newsletter. Is it $100 a year?
It's $100 a year or
Easy.
$10 a month or whatever.
$10 a month. Go get it. And we'll see you all next time on This Week in Startups. Bye-bye.